Well, good morning and welcome to the Edgar Investment Management Q3 Market Wrap-Up. My name is Matt Edgar, and I'm the principal here at Edgar Investment Management. Helping me in the backstage is Patrick Klein. We'll be running through the third quarter performance for equities, fixed income, U.S. and domestic. This video will be posted to YouTube, so if you want to check it out later, go ahead and head on over to our YouTube channel and check it out. So let's jump right in and take a look at what we're going to cover this webinar. So we're going to talk a little bit about what's happening at Edgar Investments, some quarterly hot topics, a little bit of a market summary, U.S. and international. We're going to take a look at the Edgar Sector Rotator, and we'll take a look at global fixed income, and then hopefully leave some time at the end for questions. So first of all, what is happening at Edgar Investment Management? Well, if you keep up with us on social media, you know that we have a pretty robust blog that we post on a daily basis. We also have some special blog sections. We've introduced our behavioral finance blog, which goes over different biases and sort of key findings of behavioral finance in the effort to help investors sort of manage themselves. In order to manage your investments, you really need to manage yourselves. And taking a look at behavioral finance and biases really helps us manage ourselves in addition to our investments. We also have all the major social media accounts like LinkedIn. Of course, we're on the internet. We have a YouTube station and we have our Instagram. You can see our handles there. We also have our financial advisor app. You can find that on the App Store, whether you're on Android or iPhone. Just go ahead and look for My Financial Advisor. This connects to your Blue Leaf. If you're a client of Edgar Investment Management, you're probably very familiar with Blue Leaf. This is how you access your Blue Leaf from your cell phone. We also have the Edgar Sector Rotator, which we're going to talk about a little bit more in detail. This is a quantitative-based model that identifies sectors that we believe will outperform the S&P over the coming quarter. We'll dig into that a little bit more in a couple slides. So let's take a look at some quarterly hot topics. So pretty much the hot topic for basically the last year and a half, maybe more, has been the federal fund rates and what the Fed is doing with rates. You can see here on this table on the right, we've had several increases in rates over this year. So beginning in February, our last rate increase was in July. The Fed's increased rates 25 basis points or 0.25% each time. Notably in September, we did get a pause. There is some consensus among the Fed that we probably need one more rate increase, but with inflation numbers coming out today, for instance, and showing maybe a slowdown in inflation, I think that it's reasonable to think that we may actually have a pause for the rest of this year. That being said, I think the market has probably priced in one more rate increase in either the November or the December meeting. But historically, rates are up over the last 10 years or so. We've seen really low rates basically since the financial crisis. So they've come up quite a bit over the last 2 years, basically. Moving on to equity, it was a bad quarter for equity, but it's still a good year for U.S. stocks. So if you look at the table here in the middle, you'll see these are Morningstar style boxes. So it's broken down between value, growth, and blend, small, mid, and large. You can see for Q3 across the board, it was negative for U.S. equities. Whether you were large cap value or small cap growth, it was negative. Q2, on the other hand, was a very positive quarter. And for the year, we're still positive. So it's a bad quarter, but it's still a pretty good year. And then another big hot topic has been oil. Oil prices have been surging throughout 2023, almost getting to $100, but not quite there. You can see a graph there of oil prices since the middle of 2018. So a little bit more on oil prices. here in our office, we wanted to take a look and see how oil prices impact different related equities. So we did a little bit of a regression analysis, and you can see here we looked at ExxonMobil, Transocean, which is a large drilling company, and XLE, which is the S&P energy sector ETF. And the question we wanted to answer is when we have a weekly change in oil prices, whether that weekly change is up or down, is there a correlation between those prices and those changes in prices and Exxon or Transocean or the S&P energy sector? And what we find is that there is some movement with oil prices and those three tickers in the week that it happens. So when oil prices go up, there tends to be an increase in prices at Exxon and Transocean and energy. When prices go down, we would expect to see a similar thing. It's not a high correlation. You can see here in this left-hand column, 0 weeks after change in oil prices. It is a correlation. It's not a super strong correlation, but it is a correlation. But what we see is that whatever impacts oil prices have on those companies or on that sector, it really is that week only. And we don't see any tag-on effects the following week or 2 weeks or 3 weeks later. You can really see that 1 week after a change in oil prices or 2 or 3, our correlation just really drops off. So the market is fairly efficient at pricing in the changes in oil. Obviously, it's not going to be a one-for-one relationship because Exxon has a lot of other things that go into the profitability of the business other than just straight oil prices. But we do see a correlation the week that oil prices change. Also, you can't talk about oil without talking about U.S. rig count. So here's a graph that goes all the way back to the beginning of January 2018 that shows U.S. Rotary rig counts. And you can see that, obviously the big thing you can see there is in 2020 during COVID, rig count just fell off of a cliff. And we've never quite recovered to where we were in 2018. Most recently, around the end of 2022, we sort of hit a peak and we've been sort of sliding ever since. So we're obviously higher than we were during COVID, but we haven't gotten back to that pre-COVID timeframe. And that may be some of what we're seeing in oil prices. Just not as many rigs out there drilling is sort of keeping the oil prices a little bit high. As a fun fact, the most rigs we've ever had at one time was 4,530, and that was way back in December of 1981. The lowest we've ever had was 244 rigs, which was in August of 2020. Obviously, we all know what August of 2020 looked like. We are way off of that 4,500 rig count. I don't think we'll probably ever see that 4,500 number again, just because of technological advances in drilling. We just, quite frankly, don't need as many drill rigs. All right, moving on, let's take a look at sort of the quarterly performance across the board. So a lot of red down arrows here. U.S. stock market was down 3.25%. International developed stocks was down a little bit over 4%. So U.S. did better than international developed. Emerging markets was only down a little under 3%. So emerging markets actually did better than U.S. and international developed. And global real estate was down almost 6.5%. So across the board, equities were down. So there really was no place to hide. If you had a well-diversified portfolio, you were going to experience a down quarter. Same thing with bonds, whether you're talking about US bonds or you're talking about the global bond market, it was down as well. This is all about interest rates, right? Interest rates go up, bond prices go down. Interest rates go down, bond prices go up. So you can see in the US bonds, we're down 3.23%, really very, very close to the US market, US equity market. So US equities were down 3.25%. US bonds were down 3.23%, basically the same thing. So you really didn't get much diversification if you held, let's say a 60-40 portfolio of equities and bonds. Your portfolio is going down almost 3.5% regardless. Bonds outside of the US performed a little bit better, down almost 1%, but still down overall. So really no place to go in Q3. Let's take a little bit longer term view though. If we look at the 1, the 5, and the 10 year, US stocks for the 1 year still has had a very good year, 20.46%. So we're over 20% on US stocks. International developed is up 24%. Emerging markets, while it has underperformed US and developed, still up 11%. Global real estate eking out a 1 year return of 2%. US bonds, you can remember last year had a really rough time. They've come back a little bit this year, but really kind of breaking even on US bonds. And then the global bond market is up 3%. But I'd like you to take a look at the 10 year on this. 10 year is sort of our long-term average, and US stocks have averaged 11.28%. So if you're a long-term investor, that's really the number that you're kind of keeping track of. 20% is a great return for 1 year, but you don't make your retirement on a 1 year return. You make it on being a long-term investor. Let's take a look at the world stock market performance. This looks at, kind of key events that have happened in the third quarter. There's a lot of information on here. I would draw your attention to the ones marked in green. So, earlier in the quarter, Dow had gone the longest win streak since 2017. S&P extended, had a 5-month run of gains. If you jump ahead to the end of the quarter, S&P had the biggest monthly loss for the year. So, it's sort of a little bit of a tables turning on the quarter. We had really good, strong beginning of the quarter and just sort of fell off towards the end of the quarter. You'll also see there U.S. mortgage rates hit 7.09%, which is the highest in more than 20 years. That is a really significant number. Mortgage rates have been climbing and climbing, and for them to hit a record, it's still to be determined what's going to happen with housing. But I think if you talk to any real estate agent, they're gonna say things have slowed down since sort of the post-pandemic peak, and that's going to be largely due to U.S. mortgage rates. If we go back and look a little bit further over the 12 months, you'll see some key points here. CEOs expect a U.S. recession, but most think it'll be short. This is kind of an evolving story. I think there's some things that there's some data that's come out recently that says we might actually not have much of a recession, if a recession at all. U.S. inflation has been easing. That is a really good sign for the U.S. economy and the stock market. S&P started a new bull run with big tech stocks by the end of the quarter. This last quarter, S&P was really struggling. And of course, we've got ongoing developments with the UAW and strikes. Just recently, yesterday, Ford employees walked out on Ford's most profitable plant, the one that builds, I believe it's F-350s, which is a hugely profitable product line for Ford. So that, strikes has been sort of a key event here in this third quarter. We've had, actors and writers go on strike. We've had auto workers go on strike. We've had care workers in California go on strike. There tends to be sort of a theme with workers in the third quarter and going into the fourth quarter as well. So let's take a look at country returns. So this is a slide that we presented to you back in Q2, if you remember. And I'd like to just kind of draw your attention to a couple things. Greece was our #1 performer in the second quarter of 2023. US outperformed the global market, but both were positive. Turkey was our worst performing country of the second quarter. Let's jump ahead and look at Q3 and just see sort of how the tables have turned. So Turkey, our worst performing market in Q2, is now our best performing country in Q3. And another significant, observation here is that while the US did outperform the global market very, very slightly, you can see there US is red and the global market is blue, both were negative. In fact, most countries were negative. Most countries, had negative returns for the third quarter. So quite the tables turning for country performance in the third quarter. And if we look at the relative movement for countries, you can see here, this basically says, how many places did each country move up or down on those two previous charts from quarter two to quarter three. You can see that Turkey jumped up 47 spots, went from our worst performing country to our best performing country. You can see that the global market actually moved down 9 spots. The US moved down 14 spots. So quite a big movement there for the US in terms of its ranking among different countries. And then Greece, which was our top performing country in Q2, moved down 43 spots to be our second to the lowest performing country. So, what this tells us as investors is that it really helps to be diversified. And when we talk about diversification, we're not just talking about diversified between equities and bonds, or diversifying between large cap and small cap, or diversifying between energy sector and the technology sector. I mean, all of those things go into diversification, but this also tells us that we need to diversify across countries. If you were just in Turkey, you're performing very poorly in Q2 and then you're gangbusters in Q3. Who knows where they're going to be in Q4? So we really have to diversify ourselves across countries as well. And this graph just really speaks to that. So let's move on and talk about the Edgar sector rotator. So this was as I mentioned earlier, this is a quantitative model that seeks to identify sectors that we believe are going to underperform or overperform the S&P. So all 11 of these sectors are components of the S&P, but they all have their own performance that's you can compare to the S&P. And what we've done in our office is we've developed a quantitative model that takes a variety of factors and seeks to tell us which sectors will under or overperform. Now, based on that model, if we believe a sector will overperform the S&P, then we want to overweight that sector. If we believe that sector will underperform the S&P, then we want to underweight that sector. So let's take a look at this table here. And what we have is we have the 11 sectors from materials all the way down to consumer discretionary. We have their tickers, and then we have their beginning market weight. So you can see material had a weight of 2.51% in the S&P. Communication services had an 8.41% weight in the S&P. Our largest weighting sector in the S&P is technology, and that's 28%. What our model recommended going into Q3 can be seen there in the model recommendations. So materials, energy, financials, industrials, consumer staples, real estate, utilities, and healthcare, our model told us to underweight all of those sectors. Communication services, technology, and consumer discretionary, our model told us to overweight those sectors. So then you can see next to that, to the right, you can see our target portfolio weight. That's what we told you last quarter. Now we've moved forward a quarter and we can actually look back and see how we did. So let's take a look at our Q3 performance. So if you look at the S&P overall, you can see that the S&P notched out a negative 2.43% return. So it was down. It was down for the quarter. So now what we do is we take a look at our sectors and we compare. How did they do? So you can see here, for instance, materials was down negative 4.32%. So materials actually underperformed the S&P. The S&P was only down 2.4%. Materials was down 4.3%. Now you can see communication services, energy, financials, and healthcare all actually outperformed the S&P. Now they might be negative. So for instance, financials was negative. It was down about 0.75%, but it wasn't as negative as the S&P. So we would say financials did better than the S&P because it wasn't as negative as the S&P. So now what we do is we want to come over here to this sector alpha. What is sector alpha? Well, sector alpha is just our sector performance minus the S&P performance. So if we take negative 4.32 and we compare that to negative 2.43, materials actually underperformed by 1.9%. So that's our sector alpha. If, for instance, we look at energy, which really outperformed, so energy was up 2.08% versus the S&P's negative 2.43%, we'll see that energy gave us an alpha of 14.5%. So how did we do? Well, in order to figure out how we did, we have to understand whether we underweighted it, overweighted it, and what sort of alpha it produced. So for us, a win is if the sector outperforms S&P and we overweighted it, that's a win. If the sector underperformed the S&P and we underweighted it, that's a win. If the sector outperformed the S&P, but we underweighted it, that's a loss. If the sector underperformed the S&P and we overweighted it, then that's a loss. So there's two ways we can win and there's two ways we can lose. Basically, if it's winning and we picked it, that's a win. If it's losing and we didn't pick it, that's a win. The opposite is a loss. So you can see here that we actually did not too bad. So we won on all of these sectors. So we won on 6 sectors. Now we lost on these sectors. So we lost on 5 sectors. So overall, we were 6 and 5. Not a bad track record. We won more than we lost. So that is how we performed for Q3 for the Edgar Sector Rotator. Now, Q4 is a new quarter, and the model has recommended new weightings, I'm sorry. And here's what the model has recommended. So for materials, communication services, financials, industrials, consumer staples, utilities, and consumer discretionary, the model has recommended that we underweight all of those sectors. Energy, information technology, real estate, and healthcare, the model is recommending that we overweight all of those sectors. So that's what we do. We don't question the model, we just go with it. And at the end of this quarter, whenever we do our next quarterly update, we'll take a look and we'll do this exact same analysis that we did here with our new weightings, our new predictions, and we'll see if we can beat our 6 and 5 record for Q3. So that's the Edgar Sector Rotator. We do actually have some client money in this. It's not just a hypothetical portfolio. We actually do invest in the Edgar Sector Rotator. All right, so let's move on to some performance on individual markets. So let's take a look at U.S. stocks. So as we've talked about up to this point, U.S. stocks had a negative performance for the quarter. The area that most underperformed was small growth. The area that actually underperformed the least was small value. So this is pretty interesting dynamic. We actually see small value outperforming large cap growth and large cap value. So very interesting sort of findings here on U.S. stocks. Moving ahead to international developed. Developed markets outside of the U.S. posted negative returns as well for the quarter and underperformed both the U.S. and emerging markets, which we've already seen. Value here outperformed growth. and small caps outperformed large caps. So a similar sort of theme to what we saw on the U.S. side. And then if we take a look at emerging stocks, and remember when we talk about U.S. and we talk about international developed and we talk about emerging, U.S. is obviously U.S. equities. Developed would be those countries that we consider more developed economies, such as the UK, Australia, um, you know, Western Europe, things like that. Emerging markets are going to be those markets that are smaller markets. You could say probably things like South Africa, um, Mexico. China would probably be considered an emerging market. South Korea is probably emerging, probably on its way to developed. So what did we see in emerging markets? Well, emerging markets posted negative returns for the quarter, but it outperformed both the US and non-US. And emerging markets have really been struggling over the past several years. So to see emerging markets actually do better than the US and developed is fairly significant and really goes back to speaking to diversification, making sure that you're diversified across countries, across market caps, and all of that. Here, value outperformed growth. Small caps outperform large caps. So a very similar sort of theme to developed and US. So let's take a look at the global fixed income. Really some interesting things on global fixed income. So with the exception of the UK and Australia, interest rates generally increased across developed markets for the third quarter. In the UK, short to intermediate term rates decreased. In Australia, ultra short term rates decreased. Um, Really, let's dig into this a little bit here and take a look at the US. So when we were sitting here about a month ago and taking a look at fixed income, what we saw is that the short-term rate had really sort of spiked, but that middle part of the curve hadn't really risen up very much. Well, that's what we're seeing in the third quarter is that middle part of the term structure, that 10-year out to 30, has begun to shift up. So you see the short-term rates hasn't really moved too much, but if you go out the curve, it's really starting to increase. And that's, I think, where we're going to start to see mortgage rates really respond to the increase in interest rates from the Fed. Because most mortgages are between 15 and 30-year mortgages. And so as we see that later part of the curve start to shift upwards, we're going to begin to see mortgage rates climb. And we saw that across the board for the most part. If you look at Germany, you see that same story. Longer term rates starting to creep up. Look at Canada, see that same thing. Australia, Japan, pretty much across the board, we begin to see that longer part of the curve increase. Increasing rates do cause bond prices to go down, but we always say that a higher interest rate is good for savers, right? If you're purchasing a 10 or 15 or 20-year bond that you're going to hold till maturity, you're going to like a little bit of a higher rate because you're going to get a higher yield. Now, if you already own a 20-year bond and it's priced at 3%, you really have had a hard time this last couple of years because that bond's been going down as that 3% bond has become less valuable because other 20-year bonds are selling at 5%. So fixed income is a very sort of complicated, nuanced area. It depends on what your perspective is, what you want to happen with interest rates. But it is an interesting dynamic that we're now starting to see rates increase a little bit further out on the curve. A little bit more on fixed income here. So kind of diving in a little bit deeper into the U.S. Treasury yield curve. There you can see that gray line is our September 30th, 2023 line. It's exactly the one that we just saw on the previous slide at the top middle. What you can see is that curve is inverted. So shorter term interest rates are higher than longer term interest rates. Now, it was very, very inverted at June 30th. You can see just how it spiked up here and then really fell down like this. Whereas in September, it sort of made more of a gradual decline. And that's because those longer term interest rates are rising. Now, what we normally expect to see on our yield curve is what we saw a year ago, September 30th, 2022, which is a rising yield curve. And this goes towards expectations, right? We would expect longer term rates to be higher. You need to compensate. If you're going to borrow money from somebody, you need to compensate them for time value of money. If you're going to borrow $1 today and pay it back in a year, that rate is going to be less because it's less risky than if you borrow $1 and pay it back in 20 years. So we expect to see this sort of upward sloping yield curve, which is what we saw a year ago. Now, we did have this weird little hump a year ago, which is kind of an interesting thing, but overall, it was exhibiting what we expect to see. This sort of downward sloping yield curve, this inverted yield curve, as we call it, is not what we expect to see. No telling when that will go back to being a normal yield curve, but it is inverted right now, which is interesting for fixed income, meaning that shorter term rates are higher than longer term rates. All right, so let's jump on into a little bit of time for question and answer. We're actually running really, really good on time here, so we have plenty of time to dig into some Q&A. And here the big idea with this first question is, should we panic about a quarter like Q3? Q3 was not a great quarter. We looked at it. There was really nothing good about Q3. US stocks were bad. International stocks were bad. International developed, international emerging. Even though emerging actually outperformed, it was still negative. Fixed income was down. Q3 just wasn't a good quarter overall. There was really no bright spot in your portfolio. You really just hoped to be allocated to where you lost a little bit less. So is Q3 a reason to panic? And, spoiler alert, I would say no, Q3 is not a reason to panic. And let's take a look at maybe one reason that we don't want to panic over one bad quarter. And I'd like to talk about a concept called drawdown and max drawdown. So drawdown in and of itself is just a measure of a decline from a peak to a trough. And we have peaks and troughs all the time. We have them throughout the day. We'll have a high and then a low, a high and a low. We'll have them over the course of a week. We'll have them over the course of a month. We'll have them over the course of a year. And what you can see here is these lines here in blue represent one particular drawdown. So if we look at this peak and we go down to this trough, that is a drawdown, right? If you're long stocks at this top point and you buy and hold, you ride this whole curve all the way down until you get down here. Now, luckily, you start to come back up and you hit a new peak and then you start to head back down. So that's a drawdown. That's one drawdown. There's tons of drawdowns in here. We can come through here and we can mark all these drawdowns. And it could be from this peak, this drawdown could go, you could measure it all the way down to this peak. You're just measuring a peak to a trough. Now, there's another concept that, so the moral of that story is that you're going to have peaks and troughs all over the place. Depending on what period of time you look, you might have hundreds, dozens, thousands. But you're going to have peak to troughs all over the place. So you're going to have drawdowns everywhere you go. Max drawdown is a little bit nuanced in that it is the maximum point from the maximum peak to the maximum or the minimum, I guess we should say, trough. You're only going to have one of those in whatever time period you measure. So here we're looking at 2022, we're looking at the S&P, we're looking at daily prices. What we can see here is that we hit a peak at the very beginning of the year. And we kept coming down and coming down. Now we do come up, but the thing with the max drawdown is you measure it from the decline of a peak to a trough before a new peak is achieved. So here we did not achieve a new peak. We have to get all the way up to this level. So we keep measuring our drawdown. We go here, we create a new peak, but not a peak that's as high as the other one. And we keep going all the way down to this little spot down here, which is our lowest spot before we get to another peak. This is what's known as our max drawdown. So if you are an investor and you're invested in S&P, you're going to ride this wave all the way down to this spot before you start moving up again. Okay. This is our max drawdown. So when we talk about max drawdown, this is the picture you should get in your head. We're going from the highest peak to the lowest trough before we create a new peak. You're only going to have one of those in a year. You only have one maximum drawdown in a year. You have a lot of drawdowns, but you only have one max drawdown. So all of that is just background as to what max drawdown is. But what does max drawdown tell us? So for instance, if we have a really big max drawdown, does that mean that we have a really bad year? If you're sitting here and you're experiencing this sort of decline, should you just throw your hands up and say, you know what, I shouldn't be investing, period. This is all, for naught. Well, what we find is that the answer to that is no, not necessarily. So what we did here is we graphed the annual so we went back 20 years and we graphed the annual S&P return for that year. And we also looked at the max drawdown for that year. So if we look up here along the x-axis, we have returns. So we go from a low of basically 40% all the way to a high of plus 30%. If we look on the y-axis, then this is our max drawdown. Now, obviously, all of our numbers are going to be negative. They have to be negative. Your drawdown is always going to be negative. Now, it can be a small negative, it can be a big negative, but it's always going to be negative. So we took each year and we put them on this XY sort of grid. And what do we find here? Well, we find that there was a year, 2008, where we had a huge drawdown, 48%, and we had a huge loss, right around 40%. 2008, if you remember back, was a really bad year. So if you're an investor, you're just seeing your portfolio go down, 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 down. And really in 2008, there was no hope that your portfolio would go up because overall the year was a big fat negative. Now, let's take a look though at some other dynamics. Let's take a look at the very next year, 2009. 2009 actually had a fairly significant drawdown, in the high 20s%. But it also had a really pretty robust return, almost 30%. So you can see in terms of drawdown, it really is only beaten by 2008 and 2020. So 2009 had a really pretty big drawdown, but it also had a really nice return. So it doesn't necessarily mean that if you have a really big drawdown at any given point, that you're going to have a bad year. We can see 2020, we actually had a pretty big drawdown. If we look over the last 20 years, we had the second biggest drawdown, but we actually notched out a pretty decent return that year, right around 15%. So 2020, even though it might have seemed like a bad year, obviously it seemed like a bad year for a variety of reasons, From a return standpoint, it actually turned out not to be such a bad year. So you had quite the roller coaster ride getting yourselves to over 33%, but at the end of the year, you were compensated with a pretty nice return. Now, as an investor, you sort of have to put yourself on this graph. Now, nobody wants to be on this side of the graph, right? These are returns that are negative. Nobody wants to be on that side of the graph. Everybody wants to be on this side. Everybody wants to have positive returns. The real question is, what sort of experience do you want to have? So if you look here, let's just take, for instance, 2004. Well, 2004 did not have a very big drawdown. It had about an 8% drawdown. So if you're an investor in 2004, you're feeling pretty comfortable. You're not seeing really big decreases. The max your portfolio is going to decrease in 2004 is 8%. That being said, you eked out, probably about a 5% return that year. So, it was not a crazy year. It was not a, stressful year, but it also wasn't a very profitable year for you as well. Compare that to one that we already looked at, 2009. Well, 2009, your portfolio is up and down. The downs are pretty down, but you're getting yourself almost a 30% return. So a very uncomfortable year, but also a very profitable year. And that's what you find as you move from these points that are, have lower drawdowns and lower returns, you're experiencing less stress, but you're also probably getting less of a return. Now, what do we all hope that we get? Well, we all hope to be somewhere kind of in this area of the graph, right? What does that mean? Well, look at 2003, for instance. 2003 had a drawdown of only 13%, a little over 13%. However, had a really good return of over 30%. In fact, that's the highest return we have. And in terms of drawdown, it's not the lowest drawdown, but it's also not the highest drawdown. So 2003 was a really, really nice year. It was both profitable and fairly comfortable. You can actually take this concept. So we're looking at this on the S&P, but you can take this concept to your own investments, right? The more risky you get, the more you're going to experience in terms of a max drawdown. So if you're investing in small cap growth, you should expect that at periods of time, your portfolio is really going to take a beating. But we also are going to expect higher returns when we experience more of that drawdown. So we'd like to probably be moving in this direction, right? That being said, if you are not comfortable with big drawdowns, then you're probably going to be most comfortable in this area over here. And there are asset classes that tend to live in that area. So think of more secure things like large cap value, even some mid cap value, developed large cap stocks. You're going to have less of a drawdown because you have less volatility, but you're probably going to get less of a return as well. So as the investor, your goal is to figure out where exactly you want to be on this chart. But the moral of the story, going back to our original question, should you be panicking over a bad quarter? No, because if you look at 2020, we had a bad quarter there, but we also ended up having a pretty good year. Same thing with 2009. There were periods of really big drawdowns, and overall we had a pretty good quarter. So don't panic. Think about the long term, right? If you're an investor on the long term, this is a 20-year sort of horizon. If you looked at your 20-year drawdown, annual drawdown average with your average return, you're probably going to be somewhere in this area. So don't panic. Think about your time horizon and make sure you're matching up sort of your expectations with your time horizon. Here we go. One more last thing on drawdown. You can see this is performance by year. So all the same data that we just looked at, performance by year with drawdown. So drawdown is obviously our yellow bar, and this sort of greenish bar is our performance. So you can see, overall, with the exception of a few years, the S&P actually is a pretty profitable place to put your money. Most years in the last 20 years have been profitable years. 2008 was a really bad year, but even on those years that have been negative, they really haven't been that negative. Look at our most years, though, we're pretty positive. So even though you have a big drawdown, there's not necessarily a relationship between a bad drawdown and a bad year. All right. And our final part here is I want to switch gears a little bit and talk about some research that Patrick has really been deep into. And this is our 52-week high. And if you follow us on social media or you read our blog, you'll know that we post things about 52-week highs on occasion. And the last thing we posted on 52-week highs had to do with the percentage of stocks that were within 5%, 5 to 15%, 15 to 25%, 25 to 33%, 33% to 50%, and below 50%. And we broke it up by exchange. So these were US stocks. So the exchanges we looked at were the New York Stock Exchange, the NASDAQ, the American Stock Exchange, and the over-the-counter market, which tends to be smaller cap stocks. We did that same analysis again, except this time we took all those shares, we mixed them together, irrespective of what exchange they trade on, and we divided them up by market capitalization. And we have micro cap, which are going to be our very small companies, very tiny companies, small cap, mid cap, large cap, and mega cap. Mega cap being our companies that are over 200 billion in market cap. And I think we only have about 44 of those. And what we find here, and then what we did is we compared the current 52-week high with a historical average. So you can see on this graph here, and it's very small, but you can see on this graph, if you look at, let's say, our micro cap, at the end of this last quarter, 7.33% of stocks were that are micro cap stocks were within 5% of their 52-week high. If you compare that to historical, that's slightly higher. Historically speaking, over the last 10 years, 6.5% of stocks are within 5% of their 52-week high. No other market capitalization is higher than their historical in terms of 5%, within 5% of their 52-week high, except for mega caps. Mega caps are 43.18% are within 5% of their 52-week high, when historically the average is 36.34. Interesting thing about mega caps, there are no shares that are less than 50% of their 52-week high, which historically is a small sliver that are lower than 50% of their 52-week high. So what does this tell us? Well, it tells us that maybe right now, mega cap stocks, there tends to be maybe a little bit of froth in the mega cap stocks. Historically speaking, prices are higher relative to their 52-week level than they've been in the past. If we look over at the small cap, mid cap, and large cap, what we see is within 5% of their 52-week high, we're actually below the historical average. When we move on to that next bucket, which is the 5 to 15%, we tend to be a little bit, small cap is a little bit low, but we tend to be a little bit closer on the on that metric. But here, just a look at 52-week high, current 52-week high across markets relative to their historical. And this is, like I said, you can find this on social media. You can find it on our blog. We post this. It's just something interesting that we like to look at from time to time. We don't do this analysis very often, a couple times a year, but it's just something that we like to look at that's kind of interesting. All right. Well, at this point, I would like to thank everybody for attending. We're a little bit early. So before I go, let me just thank Patrick for all of his hard work on putting this presentation together and hosting it in the background. I also want to direct everybody to some of the ways of getting a hold of us or following us. We're obviously on the web at edgarinvestment.com. There you can find our blogs. Not only do we have our behavioral finance blog, we also have an Investments 101 blog that goes over a lot of different investment topics. We also have our daily blog that Patrick writes. You can also find us on LinkedIn. Those daily blogs make it onto LinkedIn several times, during the week. We'll get those posted onto LinkedIn. We also make different special announcements on there, sort of special research topics we post on LinkedIn. You can also find us on YouTube. This presentation will be posted on YouTube. So if you want to go back and review something, you can find it on YouTube probably later today. If you want to forward this along to somebody that maybe wasn't on the webinar today, feel free to forward our YouTube video to them. Be sure to like and subscribe, as they say on YouTube. You can obviously reach us by phone, the good old-fashioned way, 832-680-4272. You can also send us a text message to that number if you like. You can find us on Instagram at Edgar_investment, and you can find us on Facebook. Just search up Edgar Investment Management, LLC. And we hope to see you on our next quarterly review. It'll be sometime in January, so keep an eye out for announcements on that date. We haven't set it yet, but we will set it very shortly. So be sure to sign up very early. And if you know somebody that might enjoy this webinar, be sure to forward it along to them. So I thank everybody for joining us, and I hope you have a great Q4. We've got some holidays coming up here, so I hope you have some good family time and enjoy some time off if that's what your holidays entail. And we will see you again in Q1 for our Q4 update.